Nvidia versus Tesla. It is the ultimate heavyweight title fight of the modern market, a clash of tech titans so massive that it dominates every financial headline, every institutional boardroom, and every retail portfolio on the face of the earth. Right now, an invisible war is tearing through the financial world, and your portfolio is trapped directly in the crossfire. We have arrived at the definitive turning point of 2026. The easy money has been made, the hyper-growth illusions have cracked, and retail investors are left staring at what looks like a brutal, binary choice that will determine their wealth for the next decade. On one side, you have Jensen Huang's microchip empire, a company that just surpassed silver to become the second largest asset on Earth, relentlessly marching toward a $6 trillion valuation. On the other side, you have Elon Musk's autonomous empire, a company burning through $25 billion in capital expenditures this year alone, explicitly warning Wall Street that it will generate negative free cash flow for the rest of 2026 to fund a radical pivot into robotics and artificial intelligence. If you put your money into the wrong asset today, you aren't just missing a rally, you are willingly tying your capital to a ticking time bomb. Most retail investors look at these two giants and see a classic dilemma. Do I buy the picks and shovels provider, or do I buy the downstream visionary? They see a real choice, but that view is a catastrophic mistake. Under the surface, the idea that these two stocks are independent options is a complete illusion. They are operating on completely opposite financial planes, yet they are bound together in a toxic, parasitic ecosystem where one company's massive cash burn is directly funding the other company's record-breaking margins. One is an unassailable monopoly pulling in pure cash right now, while the other is a massive, high-stakes gamble on a physical computing future that hasn't fully arrived yet. To understand where you must allocate your capital today, we have to strip away the CEO narratives, ignore the generic media talking points, and look at the raw, unforgiving reality of what is actually happening inside these companies at this exact minute. Let's look at the numbers staring us in the face. In its latest quarterly earnings, Nvidia reported an astronomical revenue increase of 73% year over year, pulling in over $68 billion in a single quarter. Think about that volume of capital moving through a single hardware pipeline. Even more staggering is that its data center segment alone accounts for over 90% of those sales. Nvidia isn't just selling chips, it is building the foundational concrete for the entire digital universe, and it is charging an absolute fortune for the privilege. Meanwhile, Tesla's recent reports revealed a totally different, deeply polarizing story. Tesla actually managed to beat conservative profit forecasts with an adjusted earnings per share of 41 cents against the 35 cents expected, and its total revenue climbed to over $22 billion. On paper, to the untrained eye, it looks like a clean win. The stock even surged 4% after hours as algorithm bots read the initial headline. But then, the trapdoor opened, and the illusion of a stable, predictable automotive business completely vanished. Midway through the conference call, Tesla's management dropped a bombshell that sent institutional money sprinting for the exits, causing the stock to reverse and slide over 3.5% the next morning. They officially raised their capital expenditure guidance from $20 billion to over $25 billion for the fiscal year, confirming that free cash flow will remain firmly negative for the rest of 2026. This means Tesla is aggressively spending money it hasn't even made yet, all to build an infrastructure for products that will not generate material revenue this year. The market is now forced to wrestle with a terrifying question. Will this colossal spending produce the hyper-growth the valuation demands, or is Tesla stepping off a financial cliff? To find the answer, we have to look closely at how Nvidia constructed the most dominant, impenetrable moat in corporate history. It didn't happen by accident, and it didn't start with the current generative AI boom. To truly see why Nvidia is crushing its competition today, we have to travel back to a quiet, high-stakes decision made exactly 20 years ago. A decision that almost bankrupted the company, but ultimately secured its permanent dominance over global computing. Back in 2006, Nvidia was primarily known for making graphics cards that allowed teenagers to play video games with smoother frame rates and better lighting. But Jensen Huang saw a completely different future, one that standard semiconductor executives thought was completely unprofitable. He realized that the mathematical architecture required to render 3D graphics on a screen, processing thousands of tiny calculations simultaneously across thousands of independent cores, was fundamentally identical to the math needed for high-level scientific computing, physics simulations, and eventually, artificial intelligence. He tasked his engineers with creating a software platform called CUDA. CUDA stood for Compute Unified Device Architecture. Its goal was radical. Allow programmers to use standard coding languages like C and C++ to run completely non-graphical calculations directly on Nvidia's graphics chips. It was a beautiful vision, but it came with a devastating price tag. Developing CUDA required hundreds of millions of dollars in continuous research and development, at a time when the company's core revenue was modest. At the same time, every single chip Nvidia manufactured had to include extra silicon and transistors dedicated to running this new software, making the hardware significantly more expensive to design, build, and distribute. For years, Wall Street absolutely hated it. Analysts openly mocked the strategy, calling it a waste of shareholder resources. They slammed Nvidia for destroying its profit margins to build a complex software ecosystem that almost nobody in the commercial market was using. The company's stock plummeted, profit margins contracted to near zero, and pressure from activist investors mounted to scrap the project entirely. Jensen Huang refused to back down. For nearly a decade, Nvidia absorbed the losses, quietly forcing CUDA into every single piece of hardware they shipped across the globe. They gave the software tools away for free to universities, ensuring that an entire generation of computer science students, researchers, and developers learned how to code exclusively on Nvidia architecture. Then, the world changed overnight. When the fields of deep learning and neural networks exploded out of academic labs, researchers realized that standard computer processors were completely incapable of handling the massive, multi-dimensional data loads required to train advanced AI models. They needed parallel processing hardware. And when they looked around the globe for a commercial solution, they found only one company that had spent the last 20 years building a flawless, deeply integrated ecosystem of hardware and software, perfectly optimized for this exact moment. That company was Nvidia. Because of that 20-year head start, CUDA is no longer just a software platform. It is a global, unbreakable industry standard. If a software engineer wants to build a cutting-edge large language model today, every single tool, library, and framework they use is natively optimized to run on CUDA. Trying to train an AI model on a competitor's chip, like an AMD or an Intel offering, means completely rewriting millions of lines of foundational code, wasting months of valuable time, and risking massive compilation errors. This software ecosystem is the real reason tech giants like Microsoft, Alphabet, and Meta are willingly waiting in line for months, paying up to $40,000 per chip to buy Nvidia's latest hardware. They aren't locked into the hardware, they are locked into the software. And right now, Nvidia is executing a massive product transition that is rendering the competition completely obsolete before they can even get their rival products out of the factory door. The legendary Hopper architecture, which powered the first massive wave of generative AI, is being systematically replaced by the new Blackwell NVL72 platform. Jensen Huang explicitly calls this machine a thinking engine designed for reasoning. Blackwell isn't just a slightly faster microchip. It is an entirely integrated supercomputer architecture that links 72 graphics units into a single cohesive processor, delivering up to 30 times higher throughput for AI inference tasks compared to the previous generation, while drastically reducing energy consumption per token. This brings us directly to the core problem of investing in Nvidia today, and the reason why the choice between these two stocks feels so paralyzing: valuation. With shares trading at roughly 48 times trailing earnings, many cautious value investors are terrified that the stock has run up too far, too fast, entering bubble territory. They look at the massive market cap and assume a correction must be right around the corner. But this is where standard financial metrics fail completely. A high price-to-earnings multiple is only dangerous if the underlying earnings are stagnant, cyclical, or fabricated. Nvidia's earnings are not just real. They are accelerating faster than its stock price can keep up with. Its non-GAAP gross margin is hovering at an unbelievable 72%. There is currently no other company on the face of the earth operating at this scale while keeping 72 cents of every single dollar as pure profit. But while Nvidia is busy printing billions of dollars by supplying the shovels for the AI gold rush, its biggest customer is quietly planning a rebellion that could completely alter the balance of power. Tesla isn't content with just buying Nvidia's chips to train its cars. Elon Musk wants to control the compute itself. And if you think Tesla is just a car company struggling with delivery numbers and EV macro headwinds, you are missing the entire plot of the next 5 years. The choice between Nvidia and Tesla isn't about chips versus cars. It's a choice between the infrastructure of today and the sovereign autonomy of tomorrow. To understand why Tesla commands a premium valuation that leaves traditional automakers like General Motors and BYD in the dust, you have to realize that the market is not pricing Tesla based on the number of vehicles it rolls off the assembly line. Look at the stark reality of the multiples. Traditional auto companies trade at an average enterprise value to EBITDA multiple of around 7. Tesla, right now in 2026, trades at an astronomical multiple of over 87 times. It trades at more than 12 times the industry median. If Tesla were purely a car company, its stock price would drop 90% tomorrow morning. The institutional capital holding up Tesla's valuation is making a monumental bet on a single transformative thesis: that Tesla is an artificial intelligence, robotics, and autonomy platform disguised as an electric vehicle manufacturer. The core of this entire thesis rests on FSD, full self-driving. While every other tech company is building AI models that live inside a computer monitor to write emails and generate images, Tesla has spent the last decade developing an AI model designed to interact with the messy, unpredictable physical world in real time. This is where the digital landscape ends, and the brutal battle for the real world begins. To see why Tesla's approach to autonomy is fundamentally different from every competitor in the world, we have to look at the architectural war that took place between Tesla and the rest of the autonomous vehicle industry. When companies like Alphabet's Waymo or General Motors' Cruise set out to build self-driving cars, they chose a path heavily reliant on HD mapping and active sensors like LiDAR. LiDAR uses lasers to map out the exact geometry of the environment surrounding the vehicle down to the millimeter. On paper, this sounds highly secure, but it creates a massive structural problem: scalability. A LiDAR-based autonomous vehicle can only operate safely within a pre-mapped, geofenced zone. If the car drives 2 blocks outside of its meticulously scanned area, or if a construction crew alters the layout of a road overnight, the system becomes completely blind and disoriented. Furthermore, the hardware itself is incredibly expensive, adding thousands of dollars to the production cost of every single vehicle. Elon Musk saw this limitation and chose a radically contrarian path that almost every autonomous driving expert called completely insane. He announced that Tesla would completely eliminate LiDAR, ignore HD mapping, and rely exclusively on cheap optical cameras and pure neural networks. This approach is known as Tesla Vision. Musk's core thesis was simple: the entire global transportation infrastructure was designed by humans to be navigated using 2 eyes and a brain. Therefore, an artificial intelligence system should be able to navigate the world using digital eyes and a silicon brain. For years, this strategy looked like a total failure. Early iterations of FSD were plagued by sudden phantom braking, erratic steering, and dangerous edge case miscalculations. The media ran endless headlines declaring Tesla's autonomous ambitions dead. But while the critics laughed, Tesla was quietly accumulating an asset that money simply cannot buy: data. Every single Tesla on the road today acts as a data collection node. Every time a human driver overrides an FSD action, taps the brakes, or takes over the steering wheel, that specific snippet of driving data is packaged and sent directly back to Tesla's central servers. This creates a continuous, compounding feedback loop. While a competitor like Waymo is proudly celebrating crossing tens of millions of total autonomous miles driven with its small, specialized fleets, Tesla's global fleet of millions of vehicles is racking up billions of miles of real-world driving data every few months. May 2024 and through 2025, Tesla executed a massive architectural shift in its FSD software that changed everything. They completely stripped out hundreds of thousands of lines of explicit human-written code. Rules like stop at a red light or slow down if an object is within 10 feet. In its place, they implemented a pure end-to-end neural network. The AI was no longer being told how to drive by human engineers. It was learning how to drive by watching millions of video clips of highly skilled human drivers handling real-world scenarios. The results were immediate and dramatic. FSD version 12 and its subsequent 2026 iterations began driving with an organic, human-like smoothness that stunned early testers. The car was no longer rigidly reacting to obstacles. It was naturally flowing through traffic, actively anticipating the behavior of pedestrians, and navigating complex, unmapped construction zones with complete ease. Elon Musk is now targeting unsupervised full self-driving approval across a dozen US states by the end of this year. But this massive technological leap has forced Tesla to confront a brutal financial bottleneck. Training these massive end-to-end video neural networks requires an unimaginable amount of computing power. To process billions of miles of high-resolution video data, Tesla had to build its own monstrous computing infrastructure. This is exactly where the missing $25 billion in capital expenditures is going. Tesla is actively buying hundreds of thousands of Nvidia's chips while simultaneously constructing its own custom-built supercomputer cluster, known as Dojo. This brings us to the ultimate friction point that is dividing Wall Street right down the middle in 2026. To fund this massive AI infrastructure build-out, Tesla is burning through cash at an alarming rate. CFO Vaibhav Taneja explicitly stated on the last earnings call that free cash flow will likely remain negative for the rest of the year. For short-term analysts and traditional value investors, this statement is an absolute nightmare. They see a company whose core automotive margins, excluding regulatory credits, have compressed down to 19% due to intense global EV price competition, while its capital spending is exploding. The bears look at Tesla today and see a mature car company whose unit delivery growth is slowing down, hiding behind a sci-fi narrative to maintain an inflated stock price. They believe that over the next 12 months, the reality of negative free cash flow and compressed auto margins will cause the stock's massive valuation multiple to compress violently, crushing retail investors who bought at the top. But if you think this cash burn is a sign of weakness, you are missing the entire plot of the physical computing race. When you step back and look at the entire global technology landscape in 2026, you realize there is a profound, deeply ironic relationship connecting these two companies. Tesla cannot build its autonomous future without Nvidia. Every single step forward Elon Musk takes with full self-driving, every single simulation run for the Optimus robot, and every single neural network trained in Tesla's Texas Gigafactory is directly dependent on the steady delivery of high-performance graphics hardware from Jensen Huang. In a very real sense, Tesla's $25 billion capital expenditure budget is directly transforming into Nvidia's 72% gross profit margin. This reveals the fundamental asymmetric advantage that Nvidia holds over Tesla right now. Nvidia is the universal landlord of the entire artificial intelligence ecosystem. It does not matter to Nvidia whether Tesla wins the autonomous vehicle race, or if Alphabet's Waymo takes the crown, or if a completely unknown startup emerges from Silicon Valley to revolutionize robotics. No matter who wins the consumer-facing AI war, every single competitor must use Nvidia's hardware and software to train and run their models. Nvidia profits off the collective spending of the entire global technology sector, making it an incredibly resilient investment during an infrastructure boom. But this structural advantage also introduces a massive, hidden risk that most retail investors are completely ignoring. Because Nvidia's growth has been so explosive, its revenue concentration has become incredibly tight. A massive percentage of Nvidia's total data center sales comes from just a handful of hyperscale cloud providers, companies like Microsoft, Meta, Amazon, and Alphabet, along with large-scale enterprise buyers like Tesla. Right now, in 2026, these tech giants are locked in an aggressive capital expenditure arms race. They are spending money at an unprecedented rate because they are terrified of falling behind in the AI revolution. But this level of spending cannot continue indefinitely. If Microsoft or Meta looks at their balance sheets in late 2026 or early 2027 and realizes that the billions of dollars they spent on Blackwell supercomputers are not generating a matching increase in consumer subscription revenue, they will be forced by their shareholders to scale back their capital budgets. The moment a major hyperscaler announces that they are reducing their AI infrastructure spending by even 15%, the growth narrative surrounding Nvidia will crack. Because the stock trades at 48 times trailing earnings, even a minor slowdown in forward guidance could trigger a massive institutional sell-off, causing violent multiple compression. Nvidia's current stock price is pricing in near perfection and endless demand expansion for the next 3 to 5 years. Tesla, on the other hand, operates on an entirely different risk profile. Tesla's downside risk is not tied to a sudden drop in industry-wide infrastructure spending. Its risk is tied directly to execution and timing. Tesla has already absorbed the massive hit to its valuation. The stock has spent the last several quarters correcting and shaking out weak hands as auto margins compressed and delivery numbers stabilized. The market has already heavily priced in the pain of slowing near-term EV growth and the massive $25 billion cash burn. This means that Tesla's valuation is sitting at a cyclical baseline, while its upside potential is entirely uncapped. If Tesla manages to secure regulatory approval for unsupervised FSD in just a few key states by the end of 2026, it will instantly validate their entire AI thesis. The moment the market realizes that Tesla can deploy a fully autonomous, high-margin software-driven robotaxi fleet without the expense of safety drivers, LiDAR hardware, the stock will experience a violent re-rating. It will shift from being valued as a high-capex manufacturing company to a high-margin software network, similar to the massive valuation expansions experienced by early tech platforms. Furthermore, you cannot ignore Tesla's rapidly expanding energy storage business. While the automotive segment faces near-term price pressures, Tesla's energy generation and storage segment is quietly printing record-breaking numbers. In the latest quarterly report, energy storage gross margins reached an all-time high of nearly 40%. Megapack deployments are expanding globally, providing utility-scale batteries to back up renewable energy grids across the United States, Europe, and Australia. This business segment provides a massive, highly profitable floor that protects Tesla's balance sheet while the company works through its intensive AI investment phase. So, when we look at the question of which stock to buy right now in 2026, the answer comes down to a precise calculation of risk-reward asymmetry and capital efficiency. If you buy Nvidia today, you are buying an elite, flawlessly run business at the absolute peak of its operational cycle. You are paying a premium price for a company that has already experienced an unprecedented multi-trillion-dollar run-up. While its dominance is unquestionable, its capacity to surprise the market to the upside is becoming structurally limited. For Nvidia to double from its current valuation, it would need to absorb an unimaginable amount of global capital, an outcome that becomes mathematically harder every single day. If you buy Tesla today, you are buying a company operating in a high-risk, high-reward investment phase. You are buying an asset at a time when Wall Street analysts are openly frustrated by its short-term negative free cash flow and heavy capital spending. But this is precisely where true alpha is generated. The best time to buy a generational technology platform is not when it is printing clean, predictable quarters and trading at all-time highs. The best time to buy is when the company is aggressively deploying its capital to build an unassailable infrastructure for the next massive wave of growth. Tesla's massive data advantage, its end-to-end neural network architecture, its high-margin energy storage segment, and its deeply integrated vertical manufacturing capability give it a compounding edge that no other company on Earth can replicate. By using its core automotive business to fund a $25 billion annual investment into physical AI and robotics, Tesla is building an ecosystem that will dominate the next decade. Therefore, the definitive choice for the ultimate stock to buy right now in 2026 is Tesla. Nvidia is the spectacular engine of today, but Tesla is the unrepeatable asymmetric bet on tomorrow. Allocate your capital where the future is being built, accept the near-term volatility, and hold your position as the autonomous revolution unfolds. If you want more videos like this on stocks, subscribe now. I break down real opportunities, not hype.
The content provided in this video is for educational purposes only. It should not be considered as financial advice or a recommendation to buy or sell any securities. The information presented is based on our research and analysis and is intended to help viewers understand stock market concepts and strategies.